You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way. It's the 6th of January 2024 with me, Sam Ball, and I'm joined by my co-host, John McEwen. In this week's episode, we had hoped to get back to a normal episode. However, there's not really any companies reporting because of the Christmas period. So we're just going to do a review of our own portfolios. So John, do you want to kick us off with how your own portfolio's done roughly in 2023?
Yeah, so roughly it's done quite well. And a lot of that is due to the MSCI All World Index really rallying, and I suppose a return of some of those big tech stocks in the States. And S&P 500, obviously it's a market cap weighted index, so the momentum that's come off from that has really lifted the portfolio. I think the index, if you include dividends in the year, is up about 12.5%, something like that. So that has done great things for the portfolio overall. In terms of individual stocks, what has been a winner and what has been a loser? Latterly, some of the house builders, I've got Redrow, that's rallied, and as we've seen interest rates, well, arguably hitting the top of the cycle, that's done great things for those, and they've re-rated quite a lot. Other companies that have done less well, I guess boo-hoo. It's been, I guess, a slightly better 2023, but it did have a terrible 2022. So I'm still well down, probably over 60% on that. Airtel Africa, let's have a look. I know the numbers it's been putting out, obviously we've been covering and have been very good. That's up around 6 to 7%. Obviously it's kicking out a decent sort of 3.5% yield too, so that's not been too bad, but it's not one that I follow the share price on closely. I'm very happy with how it's performing. Diageo, a company that I think is incredibly high quality, that hasn't had such a good year. We've had mixed results recently, and we did talk about in the fantasy portfolio topping it up. I've reinvested the dividends, but I haven't placed a new allocation to it in my own portfolio, something that I probably would consider doing. Other stocks, so I always had a bank in my portfolio for nearly 10 years. Originally, it started with Lloyd's and then it moved to NatWest. And that had, a really strong 18 months. But then in the last sort of year, it's had a bit more of a difficult time. Still well up on the stock, but it's, come back to earth a bit. That's taken a hit. And then Unilever as well, despite the numbers being, fairly good and it looking like it's coming back on track with a new program, that hasn't performed well. That's certainly down on the year. Let me just check the share price for Unilever. So on the year, Unilever's down about between 8 and 9%. So not so good there. But again, still happy holding it. Other stocks, I've got a decent allocation to Kraft Heinz. Again, that's had a disappointing year in terms of its share price is down between 10 and 11%. It does have a decent dividend of over 4%, and I'm up on it. I've held Kraft Heinz now for about 5 years and very happy with the performance. Certainly never expected it to shoot the lights out, but I thought it was good value when I bought it, and I'm happy with the way that the company's going. Other things in my portfolio, well, I had held Shell for about 10 years, and I sold, so far close to the top at about £24.5 a share. Just have a look. I don't like to look back and see how it's doing and have sort of seller's remorse, but Shell, so in the last year, it's up about 11. And since I sold it, it's up about 5%. And the proceeds of that, I quite boringly put into the world index. Other stocks that I sold Centrica, and we discussed it quite a lot on the show, but there've been lots of political commentary on it, political interference, and additional taxes levied. So that really didn't do anything for my confidence and I suppose the security of those stocks. But Centrica, that ironically, again, was probably one of my best performing stocks. I'm not sure exactly how much I sold it at, probably about £1.30 a share. It's currently 150. I did hold it through sort of good times and bad. So I had it in about 2016, started a position, probably paid an average of about maybe £1.80 a share. Obviously had the dividends over the years. They were subsequently cut. I did hold it down all the way to about 35 pence a share. And, it's rallied. It's been, I guess, a 2 or 3 bagger since then, but sold it at, I think about the £1.30 mark. And again, that went back into the world index. Another stock that I'd held for a long time that I sold in 2023 was Tesco's. I think it wasn't, it really wasn't a healthy company shortly after or around the time I bought it. Had the horse meat scandal, I think I bought just after that. And then we had the accounting scandal and it was in sort of free fall after that. Dave Lewis came in, really turned the business round, went back to basics, cut off all of the fat and sold it. And then it's been performing really strongly. And I know we've been very positive about it on the show. I felt that it was probably fully valued and it was difficult to see where the growth came from. So probably sold it around the £2.60 mark and it's now £3. So again, if I sort of held on to it, I'm sure I'd have done better. Very difficult to time the market. I'm happy that I have sold it. And again, that money just went sort of back into All World Index. I think probably the quality of a lot of those companies and a lot of them being sort of S&P 500 is better. And we'll see. It'll be interesting to see how Tesco's does. But I felt that there wasn't that much growth ahead. It was largely saturated. On a similar note, Reckitt, that was another consumer goods company that I held. I did sell that again around April 2023. I thought that I'd held it for probably about 6 years and it had always been in turnaround mode. It had been promised a lot. It had never really delivered. And since I bought it 6 years ago, let's just have a quick look at the share price. It was probably, if you take dividends into account, I'd probably sort of wash my face broadly flat on it. Share price probably down maybe between 5 and 10%. So again, I thought that was time for that to go. And again, money went back into All World Index, which has performed well. So overall, where that money went, it wasn't just sitting in the trading account earning nothing. It was all reinvested. The other thing that's been going on with my portfolio is, have I been investing as aggressively over the last year? Probably not. Of course, I've been reinvesting all of the dividends and making ISA contributions, lifetime ISA contributions, which have gone into stock. Perhaps holding a little bit more in cash. And, as the interest rates have gone up, I've actually added quite a lot of gilts to my portfolio. I think gilts were always something that in the old investment books, kind of Buffett style, you would read about and they'd say, perhaps it's your age, is the percentage of allocation to stocks or to bonds. And then, it becoming de-risked, I guess, as you get older and having a larger allocation to bonds. But it's not something that I'd really understood because they'd always, talk about whether it's US Treasuries or in the UK, we might have gilts. I never really got that because I thought, well, the return on them is sort of pitiful. Like, why would I do that? Why would I have these sort of short dated gilts? But it's made a lot more sense recently. And all of those books would have been written, or most of those books would have been written pre-2008, before we went into the sort of ultra low interest rate environment. And I think since those interest rates have come up so much, and maybe to kind of historically normal levels, but over 5%, I looked at these gilts and I thought, wow, actually I could buy a UK Treasury, a UK gilt, and when I bought them, because I bought a decent allocation in the summer, I could get ones that from July last year, which would be maturing at the beginning of, or the end of January 2025. So about 18 months from when I bought them. And I'd be getting a return of around 7%. And of course, we're not giving any tax advice, but the fact that in the UK, there is no capital gains tax on UK gilts, that was quite attractive. And it was never something, when I've been an adult, that I've been able to remember getting a 7% risk-free return over 18 months. So I had a larger allocation to gilts, and probably to some degree at the expense of stocks, but it was much more attractive than, a year or two ago when you were getting, well, more than a year ago, but when you were getting, 1% on your, or less on your savings accounts. And of course, that would be subject to tax. So the gilts have certainly been something that are new. And I feel that I get more as part of a balanced portfolio, and gilts, short, very like ultra short gilts, as opposed to just retaining the cash. And of course, you can sell them at sort of short notice dealing, so it's very liquid in that sense. I wouldn't say I've been converted to a gilt investor or a bond investor. I'm certainly not making predictions on long-term interest rates and, picking longer dated gilts. I can't see myself getting into that. But I think for the ultra short ones, whether they're maturing in a year, 18 months, 2 years, I think getting, I couldn't tell you now, but maybe 4.5% is not so bad at all. And when it's risk-free and largely tax-free, that's been, I guess, something new in my portfolio. Sam, sorry to bore you with all of that, but how has your portfolio been doing? It more exciting than mine?
So it wasn't boring at all. It was very interesting. My portfolio was slightly different this year. There were no gilts in my portfolio as of yet, although I do see the attraction of it. So my portfolio has done pretty well. I actually measure my portfolio April to April, so I don't have exact figures for where I was last January. I also measure it including capital contributions. For the last 2 years, I had a very, very good COVID year where I was up over 100%. And then the last couple of years, if I strip out my the cash I've put in, I was actually down for the last 2 years on the stock performances. In 2021, was it 2021? I can't remember which one was a COVID year. Yeah, 2020 was a COVID year. So I had an excellent 2020, and I think I had a very poor 2021, although because of the cash I was putting in, the portfolio basically stayed flat. And 2022 was similar, although I don't think it was down as much. And again, I think I basically kept it flat, including the cash I was putting in. And then 2023, I carried on putting in the cash, but it's actually up for the first time in a few years, even without the cash, which is quite a nice feeling. Part of that was just the way I invested. I was quite heavy on a lot of the work from home stocks, and a lot of the real COVID stocks that did well. Fortunately, I got into most of those before the big COVID run up anyway. But what happened with a lot of them was I rode them all the way up and then rode them all the way back down. And in a lot of cases, I was adding to them on the way down, which I think will work out quite well in the long term. But there's some stuff, for example, with Etsy, which is one of my biggest positions. I originally started buying Etsy at about $50 a share, maybe 4 years ago. Might be more, might be like 5 years ago now. But it was about $50 a share, and it went all the way up to, I think it was about over $300 a share. And I rode it all the way up, and then on the way back down, once it dropped to about 150, I started buying again on the way back down. And I've bought all the way down from basically 150, and I think I got it down to about 60. And then it's since started to rally again, and it's up about, I think it's about 80 or $90 a share now. And I am still up on the position, but nowhere near as much as I was. And I've got quite a lot like that. But for the past probably 3 years, I had been, again, I sold a lot. I had a decent Bitcoin position, which again, a few years ago I sold and did quite well on. So I can't remember what my cost was, but I sold Bitcoin when the Bitcoin price was about, I think it was about 45,000 a Bitcoin. And then once it dropped below 20 or around 20, I started buying it back a few years ago and started averaging in just like a fairly small amount a week. And just started doing that. And I've done that for a couple of years when Bitcoin's been pretty flat. And then I've carried on doing that all through 2023. But Bitcoin's gone up 150% in that time. So that's despite the fact I've been averaging a very small weekly amount and much smaller than what I put into my stocks. That's now about 15% of the portfolio. And that's really carried a lot of my performance. I think it might actually be over 15%. It might be more like 17 and a half. But that's from a very small sort of weekly averaging in, and then it's just on the back of this massive rally in 2023. So that's really given me a boost. I don't think I've discussed this before because I know it's just pure degenerate behavior. But now that Bitcoin's over about $40,000 again, and psychologically, I just can't really justify buying it in my head. So I've turned off my Bitcoin averaging probably about a month ago. And I started averaging into Dogecoin instead.
Oh no.
Yeah.
Why?
Well, so my logic is, I know it's got no value. I think long term it's got no value. I know I'm not making the best investment thesis for it, but it is the original meme coin. And if you look at the history of it, in every single sort of crypto pump since about 2013 or 2014, it's always had these massive rallies. And if you go and look at the graph, you can see that. And I think on the back of Bitcoin rallying now, which it has started to do in the past year, I think a lot of these other crappy coins are going to rally as well. And Dogecoin, a lot of the older ones, they sort of have one or two rallies and then they just disappear and die and get replaced by new ones. And Dogecoin, I think, is one of the few where it consistently rallies. And I think one of the reasons was that last time it was pumped up by Elon Musk a lot.
Yeah.
But I don't think that interest has gone away. And it's still ridiculously valued, but it's dropped all the way from so it went up to about 70 cents a Dogecoin at one point. It didn't hit $1. And it's dropped all the way down to sort of 6 or 7 cents. It's had a 90% drop. And I started buying at about 7 cents. And I do stress I'm only putting in a couple of hundred a month, which I'm quite happy to write off if I lose it all. I can afford to lose it, and I'm probably expecting to lose it. But I think if Bitcoin rallies, I think some of these crappy coins are going to rally as well. I think there's a decent chance Dogecoin is one of them, especially if Elon Musk starts pumping it again and all like I can't remember what they're called now, but you know, all the people that pump the stuff. Where they pump Dogecoin and they pump GameStop.
The whales.
No, not whales. They had a name, but there was a group of people that were doing it on Reddit and stuff. But I think there's a decent chance Dogecoin pumps. And if it pumps on the back of a Bitcoin pump, I think there's a good chance it gets to $1. Okay. Just based on everyone's going to be trying to pump it up to that price. And I know this is very castles in the air and I'm relying on a bigger idiot, but the logic I'm taking with it is like, if is it about 8 cents a Dogecoin now, and I'm only putting in money that I can afford to lose, and I really can't stress that enough. But if it's about 8 cents a Dogecoin now, I think what are the odds that it goes up to say $1 on the back of the next Bitcoin rally, which I do think we're sort of in the early stages of. And if the odds that it goes up to $1, it would be over a 10x. So my logic is, as long as I think there's more than a 10% chance of it happening, it's actually a fairly decent risk reward, despite the fact that it's probably either going to happen or be a near total write-off of the money I've put in. But I think the chances of that happening are probably above 10%, because I think if Bitcoin rallies, I think it's quite likely that it does happen. Whether or not it should and what that sort of says about the current state of society and investing is not really my problem. But I actually think it's got a fairly decent chance of 10xing, more than 10%. Now, that might only be 20-25%, but I think for money I can afford to lose, it's actually probably worth the risk. So that's my logic with it, but I'm not recommending anyone does this, and it's probably the kind of thing I will look back on in a year or two and just be like, why did I do that? But for the amount I'm putting in, I'm quite happy to take the risk on that. And that is just a bit of fun anyway. Then I've got my pension, which is a decent chunk of my portfolio, and that's just invested in index funds. So that's done pretty well. And then it gets the individual stocks. And on the UK side, they've done all right. Very happy with the companies that I've got and the results that they're getting. So for example, like Supreme hasn't moved a huge amount since I bought it. It's paying a decent dividend, but it's maybe only up like, I say only, but it's maybe only up like 10-15% since I bought it. And that's in a year where the market's done pretty well. But in terms of the results it's putting out, I'm very happy with it. And it's gotten a lot cheaper. Airtel Africa is another one you mentioned where it's only up 7%, but the results have been very, very good. And again, I'm very, very happy with it. So a lot of my UK stocks haven't actually moved up loads. A couple of them have. I think Games Workshop's done very well. I'll just go into the portfolio and see which ones are actually performing best. But I think Games Workshop has had a good year, and I've done pretty well on that. That probably is actually the main one in the UK one. And then a lot of other ones are pretty flat, like Gamma's quite flat. Boohoo's had a roller coaster. I didn't realize it got to 60p less than a year ago. It actually rallied from about 40p to 60. I think I must have held on hoping that I'd get my money back, and it's now at 36, but that is only down 9% in a year, and I've already lost most of the money I put in, so I'm quite happy leaving that. But that's probably Boohoo. Actually, is it? I don't know if it is the worst performer, because it's only down 9%. Overall, it's the worst performer, but it's only down 9% for the year. In terms of purchases for UK stocks, I've topped up a few things. So I've topped up Rightmove, I've I've opened a position in Supreme in the past year. That was fairly early on in the year. Those are probably, they might be. Oh, and then I've topped up Airtel Africa as well. I haven't actually sold anything in my UK portfolio, but I did a bit of a clean out, I think, just before the year end of 2022. So I had some stocks that I'd already got rid of, but in 2023, I haven't sold anything of my UK side of the stocks. And then the US stocks, I've got a decent number of them, and a lot of them are sort of work from home stocks. So I've got like Etsy, Upwork, Fiverr, Wix, which we covered fairly recently, PayPal. PayPal's not done that well, but I only started the position recently. I think it was in the last year I started. It was in the last year I started it, but that's only down about 10%. And I think I've got it at a pretty good price. Etsy's done okay. Well, Etsy's done decent recently, as I mentioned, but I've bought quite a lot on the way down. So I'm about break even on a small gain on that now. And there's quite a lot of others where the initial position's up a lot, but because I've bought on the way down, I'm not doing amazingly. One that has had a very good year is Mercado Libre. Yeah, so that's up from about $800 to $1,600. So it's basically doubled in the year. So that's apart from buying new positions, the only stock I've sold is I sold a third of my Mercado Libre position about a month ago to top up PayPal. But in terms of selling, I'm actually quite pleased because it's probably the first year where there's been very little churn in the portfolio, and I've just been adding to positions that I like, which I'm hoping will turn out to be quite a decent habit. So yeah, overall, I've had a pretty good year, but a lot of that's been carried by Bitcoin, and also the indexes in my pension. My UK stocks are pretty flat, and the US stocks are probably up slightly, but that's mainly been carried by Mercado Libre. But yeah, overall, I've had a pretty good year, and the first up year I've had since the COVID year, which is quite nice to have again. So actually, I'd be interested to know what your thoughts on my Dogecoin degeneracy, because that is what it is.
I think it for me, it's sort of bad habits. And I think I didn't like timing. I didn't like selling some of the stocks of my own portfolio. And I think it's the psychology in investing is so important. And I think even if it's a really small amount of money that you're doing it with, I think it's the bad habit that I don't like. And I think it's, being able to focus and keep it clean and keep it clear, clear strategy. So I'm not keen on it. I should have said I did have Bitcoin also, which has performed strongly. As again, I think we talked about it before, but sort of digital gold argument that I'd subscribe to, not being completely convinced by, but being sort of dollar cost or pound cost averaging into it probably now for 2 years maybe. So this last year obviously really had a big rally, and that has done well. So pleased about that. But no, Sam, I think it's keeping the portfolio clean, keeping the bad habits out. I know I've sort of moved largely for most of the portfolio to sort of index funds, which I appreciate for the purpose of an investing podcast is quite boring. But I think for me, it allows that clearer strategy, and for the biases, the emotions to come into investing a lot less.
I completely agree with you, but I just can't help myself. It is a habit I've struggled to kick. So I've talked about it before on the podcast, but I originally started buying Bitcoin in like 2016, 2017. And then I traded all my Bitcoin just before the big alt rally in 2017 into these crappy altcoins. And I didn't have loads of money at the time, and it wasn't a massive chunk of my portfolio. But I put about $2,500 in, and within like 3-4 months, I'd ridden it up all the way to 25 grand, and I'd done literally nothing. Yeah. And rather than accept how lucky I'd been, I thought it was due solely to my genius, and the market was going to carry on doing that. And I was thinking, well, I'll wait for 100 grand or whatever else. Rode it all the way back down. And I actually I think I about broke even on it. So it wasn't a disaster. But when you've been up 10x and given it all back, breaking even does feel like a massive loss.
Yeah.
But then what was really disappointing about it was the Bitcoin price was only a few $1,000s at the time I did that. And I completely subscribed to, like you said, the digital gold argument of Bitcoin. I think I did get that quite early. But because I got greedy with these alts, I traded all my Bitcoin for alts. And although I broke even on the alts, because the Bitcoin price had gone up so much, I ended up losing about 90% of the value in Bitcoin by the time I'd finished trading them. So I had the same amount in sterling, but I had 10% of the Bitcoin I used to have, which was pretty gutting, because if I held that amount today, it would be a lot.
Yeah.
But
Absolutely.
anyway, that's
Do you know
life.
how? I mean, not to rake over these things, but would you own a whole Bitcoin or?
I had 1.5 at one point.
Oh,
Yeah,
okay.
so it's pretty gutting. And
Okay.
the thing is as well, like, I know lots of people are in that position and they probably would have
Yeah.
sold at some point. But I think psychologically, I think because I did subscribe to the Bitcoin argument, I think I would have, and I have averaged in for years of it. I think if I'd held on the Bitcoin and hadn't bought the alt, I don't think I'd have sold the Bitcoin on the way up.
Yeah.
I think I would have genuinely held it all the way, because the only reason I got rid of the alts is because I just realized that I should have just held Bitcoin originally, and I was better off cutting my losses and getting 10%. Because if I'd kept the alts now, where I got 10% of the amount, I broke even on sterling and got about 10% of the amount back I had in Bitcoin. It might be sort of 5% instead if I'd carried on with it, because they haven't. I don't think they've done well since.
Yeah. And it comes back to that sort of early interview on the show with Flosser, and Flosser has some incredible. Well, he's obviously picked his stocks very well, but he's had huge conviction in some of those stocks that he's picked, and Tesla being one example. But he hasn't been trying to make a quick buck on them. He's had the conviction and he's held it. And you're sort of talking about almost the conviction that you have in the investment case for Bitcoin, which would have allowed you to continue to hold it, which you didn't retain in the altcoins and you don't have in Dogecoin. So at what point do you sell it? You sort of try and time the market. It becomes, I think, really, really difficult. And, again, with the indexes, I suppose you can have the argument that you sort of believe in capitalism and therefore you're going to own the world, as this sort of Andrew Craig book put it, and therefore you're going to do that in a low cost way. You're going to own a global tracker. I appreciate there are arguments about that, and it's market, it's weighted by market cap, and you're having a huge, US exposure, but nonetheless, that's the conviction that you have, and it's much easier to hold that through difficult times and then through the good times, and you're not tempted to sort of be trading in and out of positions.
Well, that's the thing, because like with the Bitcoin, I did have that conviction. If it wasn't for the alts, I think I would have held it. Whereas an example I would use is obviously like, back in 2016, I think we both bought Solar City shares.
Yeah.
I think it was Solar City.
It was
called. But on the back of basically the merger with Tesla that we were expecting to go through, and it was a quick 15% gain, and you got paid in Tesla shares. And you got 15%. Basically, the Tesla shares were worth about 15% more than Solar City. So within about a week or two, I think we banked. Did you hold it all the way?
No, I didn't hold it. So I think I made about 5% on it, but I didn't hold it all the way through. And again, it was conviction. And I thought, well, I don't even like Tesla as a stock, so I don't want to be left with, Tesla shares after it anyway, even if they're sort of, sold quickly. So I left that early.
Okay, so I held it for the full week or two or whatever it was. So I banked the 15%, and then I immediately sold the Tesla shares. And if I'd held those Tesla shares again, yeah. I don't know how well Tesla's done since 2016. I don't know what, because it makes me sick. Go on, tell me.
No, well, because I know how much I put in. So let me just have a look. So if I had held that position, so this is 2016. Oh gosh, this isn't going to be very nice.
That's why I don't look.
So it was sort of autumn. Okay, so 13. Should I see how much 17?
I think it's about 20x.
Yeah. So okay. So my $3,000 would now be worth about 50.
Yeah, so I put 2.5 in.
Yeah.
But I don't feel bad about that, because I know I never had the conviction in Tesla. No. I just wanted the 15%. I know if I'd kept the Tesla shares at some point along the way, I would have sold them.
Oh,
I wouldn't still hold them now at today's silly valuations.
Without doubt.
There's no way I would have held them, which is why I dumped them straight away. Whereas that's what really irks me with the Bitcoin, because if it wasn't for getting distracted by the alts, I would have held it.
Yeah, no,
so that one bothers me a lot more. But anyway, there's over $100,000 I could have had in my bank account if I just kept. But then, do you want a Bitcoin? Do you want a portfolio that's just Bitcoin and Tesla?
Well, some people do, and this year they might be doing very well if they do just have those assets. But
yeah, that would have been quite nice. I think it would have been like probably, what would it have been in total? Maybe like $5,000 total point because I didn't have much money back then.
No.
But it would have been $5,000 and it'd be worth well over 100 now, quite
Yeah.
comfortably, I think. But
Yeah,
anyway,
yeah.
that's life. But the Bitcoin bothers me more. But with this time with the Dogecoin, all it's done is it's just stopped me in averaging into Bitcoin at the higher price. And I kind of view the crypto as kind of, one almost mini portfolio. So, I've done so well on the Bitcoin, I can afford to lose a few $100 on the Dogecoin. But that's, And it is just a bit of fun. I quite like the excitement of checking it as well. But I'm not suggesting it as an investment strategy. But I would like to be here in a year's time where I'm saying, I know it was a stupid strategy, but I did 10x. But we'll see.
So how will you, what would make you sell with a Dogecoin? Do you have a figure in mind, or?
So I think if you get a big rally where they all start rallying, which you do seem to do every 3 or 4 years, I think it's linked, or a lot of stuff I've read about Bitcoin, I think it's linked to the halving cycle. So for anyone who's not familiar, Bitcoin, it's because it's decentralized, I'm massively oversimplifying it, but it rewards the people who are basically the miners who are running the network. And it releases a new batch of Bitcoin every 10 minutes to one of the miners. And that batch of Bitcoin every 4 years, the amount they get halves. So I think originally it's every 210,000 blocks, which works out to about every 4 years, but it varies slightly depending on how quickly the blocks are created. But originally it was 50, and then after 4 years it drops to 25, and then it drops again, and it drops again. I think we're at 6.25 now, and it's halving again, and it should be sometime, I think, in late 2024. And if you look at Bitcoin's rallies, that typically it starts to rally probably about 18 months before the next halving. And that is what has happened, because in the last year, it started to rally again. And then it usually kind of continues to rally for sort of 6-12 months after, and then it drops down until the next one. Or maybe 6 months after, and then it's sort of down. Usually, historically, it's been down for then 2 or 3 years. And if you look at the Bitcoin chart and then plot the halvings, it does seem to be following that pattern, which makes some sense, because as there's less and less Bitcoin being released into the wild, you've got a dwindling increase in supply, which you can see how that has some effect on the price. Especially because and then obviously I know as time's going on, more people are becoming interested in Bitcoin, and there's only so many Bitcoins to go around. So I think that's what started to happen in the past 12 months. And what usually happens is, on the back of Bitcoin doing well, all these crappy altcoins start to do well as well for maybe a 6-12 month window. And then they just drop off the face of the earth, and they drop 95%. And some of them come back, but most don't. And then the next Bitcoin halving cycle, you've got this new generation of crappy alts that just have these, 2,000% gains for 6 months and then fall off the face of the earth. But like I say, Dogecoin is one of the few that has done that consistently for a good few of these cycles now. So my logic is, once we get to the halving, I think if it's not happened within a few months of the halving, it's probably not going to happen. So that would probably be in terms of timeline, the latest I would sell. But I think obviously how high it can go is just complete speculation. But my logic is it got to, if you look at the chart, it's reached a higher and higher peak each time, and then had this 95% drop. And the last time it reached 70 cents, and everyone was saying, well, will it get to $1? And which is part of my logic. I think this next time it'll get to $1. So again, I think my logic is maybe sell at 90 cents or something like that, because everyone's going to be trying to push it to $1. Whereas if you wait for $1, as soon as it hits it, it might just immediately crash because of the psychology of everyone that was trying to get it to that threshold, even though there's no actual reason for it. But I think you'll have a lot of people pushing it to $1. So that's my logic with it. Okay. So there is some logic.
Okay, fine. Right. Shall we move on to our watch lists then?
Yes. So which stock would you say you have been, so this is excluding new purchases, but which stock have you been closest to buying and not bought? And then what are the other stocks that you like on the watch list as well?
I think closest to buying is probably something like Etsy. I think it's been, for the type of company that it is, it has been fairly priced over the last year. And I've come close, but haven't actually done it. We've covered the stock quite a lot, and to a degree, there's a bit of anchoring in terms of the prices and, psychology getting in the way there. Other companies that I like a lot. LVMH, which we've covered quite a few times on the show, incredibly high quality. I mean, the brands that it has are some of the strongest in the world. Holding me back on that is valuation, although that has pulled back a little bit more recently. And then other companies, in terms of thinking, even topping up, there's Diageo, which much closer to topping up now. I think I do have some cash that's accumulated from sort of dividends in the ISA. I've got Diageo in my ISA, so that may well be one that gets further allocation. And then Disney, I think, is in the midst of the turnaround. It's certainly, I wouldn't consider it to be expensive for the quality company that it is. So that again is something that I would consider. I think against that is that I have topped up on the way down on it already, although that would be over a year ago. So not sure whether that's sort of getting into bad habits there, but it's a company I do have a lot of conviction in and obviously have held throughout. And then I guess the sort of outsider is Games Workshop. And I know we shouldn't get anchored and think about the rally that it's had, but it's been performing extremely well. I think it's a very high quality company. And still, I guess if you look at the market cap and what the investment case is for it, it's still not that big a company.
Yeah, so what would it take, do you think, for you to buy one of or any of Etsy, LVMH, or Games Workshop? Because Etsy and Games Workshop, I kind of feel like we could have sat here and done this a year ago and they'd have both been on the list.
Yeah, no, it's a very difficult question. And I think something else, which I was going to come on to it in the background with all of this, is how the interest rates have been going up. And I think if we were talking a few years ago and, we were pretty close to zero, the case for keeping cash, whilst inflation, was very low, you still thought that your money wasn't earning anything doing nothing, and therefore it needed to be put, actively to work. And therefore, sort of there was no other option apart from going and looking at your sort of stock portfolio. What do I buy next? What do I top up on? Whereas in this last year, you've got a risk-free return of sort of 5% plus at different times. Therefore, actually keeping it and just getting your 5% has disincentivized me from going out and probably, pulling the trigger on some of those stocks. I genuinely think that it had that effect, which I suppose if you're looking at it from economic theory, it should be doing that. But I think in reality, in my own life, I can see it is having that effect. And I know we're going to come on to sort of books later, but the book that I reread this year, really influenced that too.
So does it make a difference on the company? Because obviously Games Workshop, yes, your cash is doing a lot better and there's no risk. Now you sat there with Games Workshop on the watch list and that's had a cracking year.
Yeah.
Whereas you sat there with Etsy and yes, it's up a bit from the low, but you're talking like it's still down from 300. It's maybe at $80 now or something. And the lowest it's been is like in the 50s. So it's still quite close to that low. And I think with Games Workshop, it's harder to make the argument because it's just more expensive. But when you've got a stock like Etsy where it's just churning out cash, the growth figures are pretty good. They're not what they were, but I think there was a couple of years of stabilization after the COVID year. But the figures are pretty good. It's buying back shares. It's at 14 times free cash flow. Is there any argument that obviously with Etsy, because the interest rates are higher, that's possibly why it's actually trading at this compressed multiple?
Yeah, exactly. I mean, these things, they make logical sense. However, I think when you're human, it does make it, you do have these psychological hang-ups on it.
I think that's everything in that case.
Thank you again for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.